Welcome back. Now we come, I would say, to one of the most entertaining and one of the most important parts of the course. Now we will do a very practical exercise. We will take four of the biggest companies in the world: Google or Alphabet, Apple, Facebook or Meta, and Tesla. And we will use everything we have learned till now on these real world financial statements of these companies. And we will make analysis of these companies and we will draw conclusion on what is good and what is bad about these companies running. So let's begin. Let's begin with one of my favorite companies, Google or Alphabet. We start with, as usual, with revenues. First, we will calculate our GP margin. Then we'll calculate our operating margin and net margin. To calculate these figures, we require the income statement of Google. So we come to the income statement of Google. We will take the year ended December 31st, 2021, and we take revenues. The total revenues of Google in 2021 was around $257 billion. The cost of revenues, $110 billion. If I deduct revenues from cost of revenues, what I get? Gross profit. So our gross profit is $146 billion. That gives me a GP margin of 56%. How I get that? GP revenue divided by revenues. That gives me almost a 57% GP margin, which is extremely lucrative and extremely good for a company like Alphabet, right? After that, what we do? We calculate operating margin. To calculate operating margin, what we need to do? We need to look at other expenses of income statements. We look at those expenses: R&D, sales and marketing, journal administration, European Commission fines. That comes out to be, by deducting these expenses, we get operating revenue of $78.7 billion. Next, we calculate operating margin. Operating margin of Google, 78.71 divided by 257. That gives me operating margin of more than 30%. So Google, for every dollar of revenue it is earning, it saves 30%, more than 30% of that revenue as earnings or profit for it. An extremely rich and extremely profitable business. After that, we deduct taxes and we get our net profit margin. For net profit margin, what we take? We take net income. Net income is $76 billion on a total sales of around $257 billion. So what we did was, I just took $76 billion and I divided by the total revenues of $257 billion. That gives me a net profit margin of almost 30%. Now, after calculating the margins, as we can see, they are very high when it comes to Alphabet or Google. We calculate something called free cash flow from operations after capex. In my humble opinion, free cash flows after capex is actually a much better benchmark for how well the company will perform as compared to a net margin. Why? Because net margin only tells you a very brief or a very muddy picture of your business. Free cash flow to capex or FCFs actually presents a much brighter picture. Why? Because now we are taking not just profit, but we are also deducting the capex which company has incurred to grow in future. So to calculate free cash flow from operations after capex, we take a very simple thing. We take net cash provided operating activities, and from that we deduct only the capex part. Remember the cash flow part which we discussed? What is the capex in this? There is an organic capex, that is the purchase of property and equipment. That comes out to be $24 billion. This will be reduced. And if there is any acquisitions, yes, there is. So inorganic capex, that is around $2.6 billion. So what we will do is, we will take the capex, the total capex of 24 billion plus 2 billion, and we reduce it to find free cash flows after capex. This figure will then be divided by the revenue to find out how much the Google is earning after every kind of expense possible. And this comes out to be 25%, which is extremely good for a company like Google. That means for every revenue it is earning, even after incurring all the expenditures for its growth for the future, it is still having free cash flows of more than 25%. Next, we look at something called return on equity and return on invested capital. For the equity part, for equity and debt part and cash and marketable securities, we need to look at balance sheet. So, did you see? We'll look at income statement. By looking at these analysis, we have practically looked at all the financial statements of the company. We are looking at the income statement, we are looking at the cash flow statements, and finally, we come to the balance sheet of the company. So the balance sheet of the company as on 31st December 2021, what we are interested in? We are interested in, first of all, the total equity of the company. The total stockholders' equity is almost $251 billion. What about the debt of the company? Now in debt, we will take the long-term debt and the short-term debt to find the total debt of the company. The total debt of the company for the long-term debt we have $14 billion. We have our deferred revenues, that is around almost $535 million. Income tax is not a debt, although it is a liability, but it's not a debt on which we are funding our company. We have operating lease liabilities, which are absolutely a long-term debt, and we have other long-term liabilities of around $2.2 billion. So for the long-term debt, we are taking the long-term debt of $14 billion. We are taking operating lease liabilities, which are a part of long-term debt, and other long-term liabilities. That gives us a long-term debt of around $28 billion. For the short-term debt, we will look at the current liabilities. Now, out of these current liabilities, I could have taken no amount as short-term debt, but for the purpose of this exercise, I believe that accrued expenses and other current liabilities should form part of our current liabilities, that is a short-term debt. All the other expenses, all the other liabilities like accounts payable or creditors, accrued compensation, that is salary payable, accrued revenue share and deferred revenue share, that is advance received from customers for the share. According to me, this is not at all a debt in terms of the debt taken to expand the company. But accrued expenses and the other current liabilities of $31 billion, according to me, when I look at the notes of the company's balance sheet, then I find out that it can be taken as short-term debt. So we took a short-term debt of 31 and a long-term debt of $28 billion, giving a debt of $59 billion in the case of Google. And finally, we look at cash and marketable securities, which is more than $136 billion. So what will I use this for? We will use this to calculate, first of all, return on equity. Now, how do you calculate return on equity? What is return on equity? It is basically the income which is available to the owners. What is the owner's income? That is the net profit. How much net profit has company earned? It was $76 billion. So we take $76 billion, we divide it by the equity capital of the company, that is $251 million, and Google has a return on equity of more than 30% on its equity capital. That means the owners of the Google, the equity shareholders of the Google are earning 30% of the income, are earning 30% every year of the amount put up by them, which is extraordinary returns. Next, we understand how much is Google making as a company as a whole. For that, what we have to do, we have to take equity plus debt minus cash to find the invested capital first. In this formula, this is what we have done. We have taken equity 251 plus debt 59 minus cash and marketable securities. These three formulas gives us invested capital. Now, how much Google has earned on these capital, on the whole capital, that is operating revenues, right? So operating revenues is 78.71. But if you remember, as per the last class, that is not the whole picture. How much tax has Google paying on its net income will be used to find the EBIT 1 minus T to find the return on invested capital. Now the operating revenue is 78.71. How to find how much tax the Google has paid? Well, it's quite simple actually. What we will do, it's quite simple actually. What we have to do is we just have to find what was the tax paid by Google in 2021 on the total taxable income. That tax can be found out by 14.7 billion divided by 90.7 billion. So that gives us a tax rate of 16.2%. So what I've basically done in this formula is I've taken my operating revenue and we have multiplied it with 1 minus tax rate. That is, this figure 78.71 into 1 minus 0.162 gave me the operating income after taxes. So this figure divided by my invested capital gives me return on invested capital of Google, which is 38%. These are the criteria which I usually see to understand the financial health of the business. Of course, there are so many other criteria which we can see, but these are the basic one which I always use to understand the business health of the company. Now, one other metric which I use to calculate how much the company is reinvesting is something which I call net capex plus change in non-cash working capital. So how do I calculate that? Well, net capex is calculated by taking their actual capex from cash flows and deducting depreciation from it. Why I'm deducting depreciation from it? So you remember I told you depreciation is nothing but a proxy for repair and maintenance. Now, if I say that 24.64 and $2.8 billion has been used by Google or invested by Google for its future growth, then this statement is not entirely correct. Why? Because like we said, depreciation and amortization represents repair and maintenance cost. It's a proxy for that. So that means the actual amount put up for future growth is 24.64 plus 2.8 minus, because it is a non-cash expense. Remember? So minus 11.555 minus 886. This is what we have done as net capex. This is the amount which has actually been reinvested by Google for its future growth. Then we have to understand that company not just grow by investing in capex. The other way to for the company to grow is by investing in its working capital. What I mean by that? Well, the company, if say wants to increase its sales, then one of the ways to increase the sales is to give more credit to its customers. So what will happen? The account receivable will have a negative balance, like it is happening here. In this year, Google has 9 billions more of debtors. That means Google has invested more of its money into debtors so that it can grow. So in that way, we take change in non-cash working capital. So net capex plus change in non-cash working capital give me my reinvestment. And this reinvestment is extremely important for deciding how much the company is actually putting for future growth. So this reinvestment is calculated by reinvestment amount. So we took the operating revenues and we divide it by the reinvestment amount to find out the reinvestment rate of the company. Now, is this an exact science? Absolutely not. This is one of the metrics which have been prepared by a lot of financial analysts to understand what is actually happening in the companies. And this is what I want to leave it with you. See, people try to give you these GP margins. All of these things are guideline and benchmarks and pointers to understand what is happening in your company. There are so many other ways where you can enhance your knowledge by understanding your financial statements more and more by finding out new metrics. For example, one of the metrics can be instead of deducting the capex, I could have just taken free cash flow from operations and compared it with what? I could have compared it with my operating revenues, or I could have even compared it with my net income. So what's the difference between net income and free cash flow from operations? Well, net income is not taking the effect of working capital. If I am managing my working capital better, does that mean I am more effective in my business? Absolutely. So there can be one more metric of calculating the net income and comparing it with free cash flow from operations. The purpose of this course is not to bind you in a specific financial analyst mindset. The purpose of this course is actually just the opposite. The purpose is to free your mind, to make you understand in depth what are financial statements telling you and give you the ability so that when you want to understand anything about financial statement, you don't need an analyst or a professional mindset. You can do it by understanding the financial statements and your business.